investors be expecting today? And is this a relief rally could really be counted on if this holds?
Well, I think the headlines that Trump and Xi are actually speaking again, I mean, we've been hearing this, obviously, it's been going on for a year now. So when we hear about constructive talks, well, they haven't been that constructive because there is no deal. And both sides, unless they're willing to compromise, there will unlikely be a deal. And then, of course, all this data that has been soft outside of the U.S. consumer data has people worried about growth, and that's reflected, obviously, in the yield curve. So I think the rallies will be questioned, the sell-offs will be feared, and until there's more clarity on trade, until we see what the Fed is going to do, and certainly what the ECB is going to do in middle of September in terms of where global bond yields are, I think markets are going to be on edge.
And it's amazing when we think about what's been going on globally. Of course, we're very focused here in the U.S. because that's where we sit. But my gosh, Argentina lost half of its value in one day earlier in this week. So we're seeing global markets obviously flashing some warning signs. How much should we be reading into that for the action in the United States when we're looking at indications of economic slowdowns?
We are in the longest expansion on record, as we know. When you are this deep into it, you have to watch your back. You have to ask yourself, okay, we've never done this before in terms of length of expansion. What's going to hurt it? What's going to kill it? Typically, it's the Fed that kills it, or it's some sort of government policy. Now we have the Fed. We have 9 legacy rate hikes and the quantitative tightening that's still filtering through. And now we have this trade fight that is clearly slowing global growth. So we have government policy that is now trying to kill this economic expansion.
Although Kashkari and Bullard are thinking about at least suggesting the idea of a rate cut sooner rather than later. Another one here upcoming.
I mean, that's their fallback position. Weak growth, let's cut rates. The problem is that they're not analyzing what will likely be the ineffectiveness of cutting rates. I mean, if you're looking to buy a house, the bond market just cut rates for you by 100 basis points in terms of you getting a mortgage. Has it really helped home purchases? Not really. It's mostly helped refis because the buyers are saying, well, rates are dropping because maybe the economy is slowing. Let me hold back. And we also have unaffordability issues also. So I think that monetary impotence is going to be a problem when they go down this further path of cutting interest rates. And they also have to be careful about cutting too much because I don't want them to repeat the mistakes of the BOJ and the ECB of damaging their banks and getting trapped at the zero bound and the negative bound, obviously.
Right, of course. So I want to take a minute here and have you listen to something. Bridgewater Associates founder Ray Dalio speaking exclusively with CNBC, out with odds for a U.S. recession before the next election. Take a listen.
Recessions are always inevitable. The only question is when. And I think that.
Do you see one coming?
Yeah, I think that in the next 2 years, let's say prior to the next election, there's probably a 40% chance of a recession. And I think that you're seeing this around the world.
So what do you make of that, Peter? 40% chance before the 2020 election?
Yeah, I mean, the manufacturing and trade side's already in a recession. It's the U.S. consumer that's keeping us out. So the question in determining whether the U.S. economy goes into recession is what does the consumer do? And that will be determined by hiring and wages, and I believe also the stock market. You get a stock market decline, you tip over the consumer. You get further weakness in manufacturing that spills over into services, you get a slowdown in hiring, a slowdown in wage growth, a crimp on consumer spending, then you get a recession. So I would actually say, unfortunately, the odds are probably higher than that, because of where we're going here and the inability of central banks to sort of save the day.
That's interesting. So watch the stock market
but it can
and
be
see
reversed.
if that tips over the consumer.
The biggest stimulus plan we can have right now is getting rid of the tariffs.